When you choose to start a company, one of the forms of ownership you could choose is the C Corporation. Most big companies, companies you've heard of, and the companies that have stock that trade on the stock market are organized as C Corporations. C Corps are owned by the shareholders. The shareholders may or may not be actively engaged in the business. So you may own stock in Pepsi-Cola, and you don't necessarily have to work at Pepsi in order to be a shareholder. Conversely, you can work at Pepsi-Cola and not own the stock. So the owners and the workers are not necessarily the same group. When a C Corp earns profit, the profits are taxed at the corporate level. Then when distributions are paid out to the shareholders, they also get to report those earnings on their personal or individual tax returns. So in essence, the profits are taxed twice. One great advantage of a C corporation is the legal shield. The shareholders have no personal responsibility for the debts of the company. In other words, their liability is limited to the amount of money they've invested in the company, essentially to own the stock. C Corp is one of the most expensive and onerous forms of ownership. There are a lot of legal paperwork to go through and then annual requirements for filing. So C corporations have a great advantage of the legal shield, but there are some disadvantages from the reporting requirements and the double taxation.